Hi. So let's see. Great. I can see myself on the other screen. Again, this is Cormac Kinney. I'm the founder and CEO of Diamond Standard. Welcome to our seminar. We're going to try to have these every couple weeks, so you're welcome to attend again or invite your friends and colleagues. Our goal today is not a sales pitch. We're going to basically walk through the Diamond Standard commodity. How do we make it? How does it work? What we see as the supply and demand for diamonds, why this might be an interesting investment for you, and the different formats that the commodity comes in. So to kick it right off, this is what we started with. This is a Diamond Standard coin. And as you can see, there's diamonds in there. And the breakthrough is that each of these coins and all coins are equal. Every Diamond Standard coin contains a mix of diamonds that are optimized so that they always add up to a public standard. That means we had to consider the carat weight, the color, the clarity, all the different aspects of diamonds, which make diamonds more or less scarce, more or less valuable. As you probably know, as diamonds get larger, as they get more flawless, as they get more colorless, their value goes up exponentially. So it's not so simple as just putting 3 carats worth of diamonds into every coin. We had to invent a process that I'm going to explain to you and make sure that it's public and transparent and fair, so that a coin we make today and a coin we make in 30 years will still always contain the same geological content. The other product that we've made, which if you have been paying attention, is we now have a Diamond Standard bar. What's different about the bars is that the diamonds are all much larger, and every bar is always worth 10 times the value of a coin. So you can compare the size of the diamonds in each. This bar is right now under its initial public offering, which is regulator supervised. What that offering does is we sell about $50 million worth of these bars, and then we buy the diamonds and we get a certain yield. We discover from the market how many diamonds you get for $50 million of that characteristic, and we buy a little bit of everything. So that'll make more sense in the presentation. But the last thing before we start, I want to kind of show you a little bit about the market acceptance we're starting to see. This is an article from last year in the Wall Street Journal. The world has been waiting for a diamond commodity. It's a $1.2 trillion asset that has always been just out of reach to investors. And our goal has to make that investment, diamonds, accessible, to make it fair, transparent, and regulator approved, to enable all kinds of investors to start to use that as a position for the very first time. So let's look at a few slides and I'll explain a little bit more about how everything works. One second. All right, here we go. So we're actually going to start at page 25. So I mentioned to you the coin in the bar, and this gives you an overview of how the whole system works. Inside each coin, there's a wireless computer chip that does 3 interesting things. Number one, it provides auditing. So while the coin is at a custodian, you can audit it. It provides authentication. So the chip contains all the proof that about the diamonds inside, where they came from, how they were acquired, and proof that they're part of a fair public sample. But the most important part of the chip is that it stores a blockchain token. So while the coins and bars are sitting in a vault, the owners can actually trade that token and whoever owns the token owns the commodity. Diamond Standard is the only company in the world that has a regulatory license to use a token as settlement of custody ownership. And that license is from the Bermuda Monetary Authority. They also oversee the entire production process, which we'll explain next. But what's interesting about the token is that it opens up a world of applications in the financial markets. Number one, that token is the spot market. If you want to buy the commodity, you simply go to a digital exchange and you buy that token, or you can buy a new commodity from the Diamond Standard website. But that token, once you own it, can be delivered to different types of structures. For example, what we've launched today is the Diamond Standard Fund. Now, all the commodities the fund owns are sitting in a vault at Brinks, but the proof of that ownership is the token that the fund also holds. These tokens have also been approved to settle futures and options, which in the case of the futures are being listed on the CME exchange, and those are currently in development. In the near future, we'll be launching an ETF, we hope, and that ETF will make this commodity accessible to a much larger world of investors. And finally, we're going to be launching what's called a commodity currency, Bitcarbon, which is a currency that comes out of the token that's built into the coin or bar. The way we make the coins and bars is interesting. The foundation is that between the coin and bar, we use 94% of the varieties of diamonds. That means that we are something that's never existed, which is a natural market maker. We can use 94% of diamonds, therefore we can bid on 94% of diamonds. And we built the world's first electronic diamond exchange to do exactly that, which is called the Diamond Standard Exchange. You can see that at thedse.co. On this exchange, we make about 16 million bids a day, and that's for every combination of carat weight, color, and clarity of diamonds. And those bids are electronic, so they're everywhere in the world. And our market making system automatically raises those bids selectively. We force the market to tell us what's the price to acquire a statistical sample of every kind of diamond. So every week through this automated market making, we buy a pile of diamonds, about 10,000 at a time. And we can prove that every pile of diamonds is statistically equivalent, meaning they have the same frequency of decolor, the same distribution of clarities, the same median of carat weight, for example. All, whether we make that pile today or in 30 years, we can always prove that we forced the market to tell us the cost and deliver an equivalent set. The last step of our process is we provide settlement. So we're the only company in the world that does diamond settlement globally. We have offices in India, Hong Kong, Thailand, Israel, Dubai, etc. And we move the diamonds where they need to go in order to be assembled into the coins and bars. That process is done using an optimization system, which is also a pretty significant breakthrough. And this pile of diamonds that we buy every week is divided fairly into coins and bars so that every coin gets an equivalent sample of the entire market. That sample is itself representative of the yield curve of all diamonds. What I mean by yield curve is the earth produces a certain frequency of flawless diamonds, a very small frequency, and every coin on average represents that frequency that you find in the earth. So every coin and every bar is a representative sample of all of 94% of the diamonds that are available in the market. Again, the bar is 10 times because it doesn't have 10 times the weight. It has 10 times the scarcity of diamonds. They're all larger in this case. This entire process is regulator approved and regulator supervised by the Bermuda Monetary Authority, simply because there's no regulator in the US that regulates this. We had to find a regulator. And that process is also audited by Deloitte to make sure that it's fair and transparent and consistent. Now, let's talk about what we do with that. Our goal is to financialize diamonds so that they become equivalent to precious metals. And if you look at every precious metal that's out there, investors own at least 15% of the global supply. Even palladium, which I've never even seen a bar of palladium, but 15% of all the palladium in the world is held by investors as a store of wealth, as a hedge, or underlying futures and ETF shares, for example. That palladium never sees the light of day. It's never used in industry. However, for diamonds, only 1% of diamonds are held by investors, meaning it's not jewelry, it's not in inventory of a retail store, for example. We believe that now that we've created a fungible diamond commodity, and now that we're creating the futures, the options, the ETFs, and the other financial products, we believe that diamonds will catch up with palladium, and that 15% of the supply, which is 1.2 trillion, will over time be acquired by investors. The way we're achieving this is, number one, we built first the fungible spot commodity. The Diamond Standard coin and bar can be traded on spot exchanges. We're launching our own, but soon will be listed on a number of digital asset and cryptocurrency exchanges, or you can trade them through brokers. But over time, we're launching a multitude of additional financial products. We've already launched the Diamond Standard Fund. We are developing 2 ETFs, one in Canada, one in the US. And as I mentioned, we already have the approval, and we're now developing the futures and options to launch in the US. Ultimately, there's going to be a very interesting inflection point where the demand will very suddenly increase. And that's going to be when diamonds, for the first time, are added to the commodity indices. What you have are a lot of institutional investors, a lot of pensions, endowments, sovereign wealth funds, who allocate 3 to 7% of their capital to commodities. They generally then invest that percentage proportionally to the index. So whatever's in the index is in the sovereign wealth fund. Diamonds will be added for the first time, and that'll create a very substantial new demand for diamonds. Part of our investment thesis in general is that this progression of products, which pull diamonds up to a 15% demand, where investors will own 15%, we believe that will drive prices up quite substantially over the next 5 to 7 years. One product a lot of you I know are interested in is the fund we just launched in partnership with Horizon Kinetics, which is the Diamond Standard Fund. Up till now, we've only sold the commodity directly, meaning that if you want to invest in diamonds, you had to own a physical commodity. We could store it for you in Brinks, for example, but there's actually relatively few investors that like to own commodities directly. Think of the number of people who own gold bars, the gold bugs. They're out there, and we have plenty of those as clients. But most clients, if you're a fund, if you're a family office, if it's an IRA, you prefer to own a fund that's in your brokerage account, and we take care of all of the custody, all of the trading, all of the insurance, things like that. This fund is just launched. It is administered by a third-party administrator. We have an auditor, which is with them, and our partner in this fund is Horizon Kinetics, which is an $8 billion investment manager. They run some ETFs and mutual funds, and they have over a 30-year track record of investing in very innovative things, often as a contrarian investor. For example, they were one of the first funds to invest in Bitcoin. This fund has a 2% fee, and it covers, as I mentioned, all of the costs of maintaining the commodity. If you're interested in the fund, visit fund.diamondstandard.co. Let's talk a little bit about the investment thesis and what we expect in the diamond market over the historically, but also in the future. So, as I mentioned, diamonds have been really left behind. While gold was available in an ETF and futures and options and everything else, diamonds were never financially accessible to an investor. An investor could never mark to market. And if you can't know what your investment is worth, a fund can't hold that position. So that's what we've changed. But over the last 20 years, that wasn't possible for diamonds. And gold, for example, went up 6.4 times since 2002 to 2022, while diamonds have been relatively flat this entire period. A lot of that was from the demand created by ETFs, which are hundreds of billions of dollars of AUM of gold. Since the last 2 years, though, something's changed. For the first time, starting with that article in the Wall Street Journal, diamonds have been available to investors as a commodity. And as a result, partially from that demand, but also because of the diamond market for jewelry, diamonds have gone up over 30%, 28% last year and 6% this year, meaning that diamonds have not only outperformed gold very substantially, but diamonds even outperformed the S&P 500 and the NASDAQ over the last 2 years. We expect that trend to continue because of a commodity supercycle and because of the demand that we are opening up for diamonds. One driver of that is inflation. So this is actually a chart from a couple months ago. It's continued to grow. Inflation is at its all-time high since the early 80s. And this drives price appreciation in commodities. As everything becomes more expensive, commodity costs rise, and very often they can be a hedge against inflation. This inflation is going to continue, but regardless, commodity supercycles generally last 10 to 20 years. So the timing of the diamond standard commodity is very fortuitous in that sense. It's also, some of you may know I was a former portfolio manager at Tudor and Millennium, where I traded quantitative strategies. So this fact is very interesting to me, but also to a lot of institutional investors, which is over 2 years and 20 years, diamonds have had literally negligible correlation to any other asset class, even gold. Over 20 years, diamonds have had a 0.0 correlation to gold and silver and stocks and bonds. So there's no other asset that you can find that have this lack of correlation. They're even uncorrelated to VIX, the volatility index. That correlation has continued as diamonds have been uncorrelated to the market over the last, this year especially. And if you can add an uncorrelated asset to your portfolio, especially if it has the return that we expect, that reduces the risk and volatility of whatever your other investments are. Now, I want to note, we do expect this correlation to increase over time as diamonds get linked by liquidity to all other financial assets. They will, I believe, naturally become more correlated than they are now. Let's talk about the demand side for diamonds. What's driving diamond prices up? Well, before Diamond Standard was on the scene, jewelry was doing just fine on its own. Jewelry demand is at its highest point since 2015. During COVID, a lot of people were home, unable to travel and eat out and do a lot of other things, but they were able to shop online. So diamond prices are driving up because of that increase in jewelry demand. And we're seeing that increase in demand in every market around the world. This data comes from Bain, which does an annual report. But in Asia, Europe, and the United States, demand for diamond jewelry has been growing and is at its all-time high. That demand is forecast to continue for the next 5 years at least. In the case of Richemont, which is the parent of Cartier, Van Cleef & Arpels, and other jewelry companies, their revenue growth is projected to be 7.8% annually. The average for the entire jewelry industry is between 3 and 5% over the next 5 years. That demand, we think, continues to push diamond prices higher. But because of COVID, you had a lot of mines closing to protect themselves from outbreaks. And so the inventories fell very dramatically. In fact, inventories are near their all-time low. I'm talking about inventories of rough diamonds. And by the way, contrary to a lot of people's belief, De Beers does not have a stockpile of diamonds that they can unload at any moment. De Beers has been public for 20 years. We know their inventory on average is 9 to 18 months of supply. So it's relatively low. But right now it's at its all-time low. And that's now hitting the supply chain, which we think will continue to drive prices up. That's the demand side. Supply of diamonds is very unique in the world. Supply has been falling every year, and that's because diamond mines are being emptied out. They haven't discovered a new diamond mine in 25 years. And the last mines that they discovered up in Canada, already 2 of them have been emptied out and closed. They've closed the last diamond mine in all of Australia. So the supply is diminishing, and it's expected to continue to diminish as these mines get closed. The only place they have found some new supply of diamonds is actually out to sea. And if you're not familiar, diamond mines are formed by basically extinct volcanoes, and they kind of go down and get compressed in the crust of the earth, and they come back up, and then they can be dug up. But a lot of those mines over millions of years get washed out by rivers, or the tectonic plates move. So anyway, they've just delivered the 5th diamond mining ship that basically scoops up seabed and tries to filter out the diamonds. That supply is still only like one average mine, in fact, a below average mine. So that's the supply case. The last thing I'll mention on supply is Alrosa is the largest supplier of diamonds in the world. They produce about 30%. And due to the invasion of Ukraine, Russian diamonds have been sanctioned. We can't buy diamonds from Russia. There's some that might go through India and become an Indian product once they're cut there. But even the Indian banks won't allow the vendors to pay Russian miners for diamonds. So the supply has been significantly choked off. We have seen some lightening of demand for jewelry because of the inflation and the overall economic situation. So diamonds haven't shot up as much as we thought they might have, but the supply is starting to really cut down. And a lot of the diamond cutters in India have laid off their diamond cutters because they're not able to get supply. The last thing I'll mention before we go to questions, and if you have any questions, please type them in, and Chris will go through the questions, and I'll answer them best I can. But the last thing I'll mention is the ESG aspect of diamonds. This is a great ESG investment. Number one, because diamond mining is among the cleanest of mining of materials that are mined. You don't use a lot of chemicals the way you do when you extract copper and nickel and things like that, even gold. You just dig up rocks, crush them, and you find the diamonds. But interestingly, once you have that diamond, it's $1 million per ounce compared to gold at $1,800 an ounce. So the transportation, the storage, the cost to carry for diamonds is a fraction of what it is for gold, and it's a tiny fraction of what it is for silver. Diamond Standard is doing a lot to level the playing field. We buy diamonds in every major country, which means you don't need to be a global powerhouse to sell to us. We can buy from the mom and pop, local miners and diamond cutters all around the world. So we're creating a lot more fairness. To be a member of our exchange, you have to agree to no child labor, no manipulation, no you have to have ethical practices. But in the long term, what I think is most interesting, 85% of all the diamonds that are accessible on Earth, we think have already been extracted. They've already been sold to consumers as jewelry. All the diamond mines are diminishing. So we think there's only 15% of supply left, and that's accounting for improving mining technology. Our expectation is that we need to buy over time the vast majority of our diamonds to deliver them to investors. We need to buy them from consumers. So what we're creating is a social dividend where we're buying back tens of billions and potentially $100 billion worth of diamonds from consumers. And as prices go up, we expect to pay more than your great aunt paid, or if you're a divorcee, more than your fiance paid. So we think that diamonds over the next 10 years will be one of the most important ESG stories. So that's kind of the overview. I'm happy to answer questions and refer back to this slide as they may come up.
Sure. With the first question, fund fails first 12 months while investment is locked up, will there be any compensation to the investors?
Can you say the question again?
If the fund fails in the first 12 months while investment is locked up, will there be any compensation to the investors from Lewis?
I don't know how the fund could fail. So the fund is very, very simple. The first of all, the diamond commodities are already regulator approved. So that was a huge milestone before we could even think about this fund. The diamond, the commodities are tradable. We've delivered tens of millions of dollars of these commodities to our custodian at Brinks. So there's not going to be a failure of delivery or of production or of approvals. So I'm not sure how it could fail. The fund simply owns commodities. If the fund were to wind down, the fund would either deliver the commodities to the investors at their option, which would not be a taxable event to take a distribution from a fund that owns commodities, or it would sell the commodities and distribute the proceeds to all the investors. So, and by the way, our partner which is Horizon Kinetics, has been running funds for 30 years, more than that. Very, very experienced fund managers. We have third-party administrators, so they manage all of the inventory, all of the assets, the reporting. We have a third-party auditor, which is Witham, which is a first-class auditor, and we have a third-party custodian, which is Brinks. So I'm not sure how the fund could fail. It could wind up. I guess maybe that's the question.
When will current investors be able to trade our coin from the initial offering?
So you could trade today, but you would have to find your own buyer. And that's been the problem. So we've met with a lot of exchanges, and a lot of them are prepared to list the token that's inside the coin, which is the BCC. It's an ERC20 token that's built into the chip. As long as your commodity is in Brinks, you could trade your token. The problem is there's very, very few owners of coins that actually want to sell. Everybody would like the ability to sell, but nobody's actually willing to sell. And so we've had a hard time getting any exchange to list the token until there's a lot more float and a lot more willing sellers. In the meantime, what we've built and will be launching very shortly is a peer-to-peer marketplace, which will be accessible via diamondstandard.co, which enables anybody who owns a coin and therefore a token to offer their token to any customer that's coming into Diamond Standard. Every new buyer of a commodity can decide, I'd rather buy an existing commodity that's already been delivered, or I want Diamond Standard to make me a new commodity. When you buy a new commodity, it can take 45 to 60 days for us to buy the diamonds, get them graded, inspected, delivered, and assembled, and then delivered to Brinks. So for 60 days, you're locked up as a direct commodity buyer. If you're a long-term investor, who cares? You don't intend to sell it. But and you also have to pay for shipping. If you want to buy someone's existing coin, you don't have to pay for shipping, and you don't have to wait to take delivery. You basically can take delivery in 30 seconds. And you could also take physical delivery if you want. So that peer-to-peer exchange will be launching in July, is the short answer to that. Sorry for the long answer.
How will lab-made diamonds impact Diamond Standard?
Well, so lab diamonds were actually a huge benefit to us because we're very threatening to the diamond industry. We're creating a lot of transparency. It's like decimalization for anybody my age. That was very scary to the brokers. So because of the threat of lab-grown diamonds undermining the diamond industry, all of the gem labs, all of the diamond vendors, they were willing to partner with us. We now have 150 members of our exchange that offer us diamonds for all of our bidding. So that's number one. It enabled us to get the supply. Number two, we expect that we're going to buy 15% of diamonds. That's today 180 billion worth, which is about 8 years of production. There's no way we can buy 8 years of production without driving up the price by multiples, maybe even 10x. It would be 5x before diamonds catch up with gold. So as diamond prices go up because of investor demand, we think that lab-grown diamonds will become the substitute more frequently, in that mall-based jewelry stores like Zales, they're going to have a hard time selling a diamond ring at 5 times the price. So we think a lot of the lower market will shift to lab-grown diamonds. And we think, natural diamonds will become much more scarce and valuable, and also have a tremendously higher resale value, because we're going to be buying used diamonds from consumers based on the exchange price. So there'll be a lot more transparency for natural, and lab-grown diamonds become a lot like blue jeans that you wear and you throw away, because already today, lab-grown diamonds have nearly zero resale value. You can't trade in. Zales won't take lab-grown diamonds for a trade-in, and you could never sell a lab-grown diamond for anything remotely like what you paid.
With futures, ETFs in place, will diamonds relate to and be as volatile as metal and commodities experience?
Well, there's an interesting dynamic, which is initial position building. So everybody who wants gold has gold, right? And fund may adjust their position up or down. A central bank may adjust it up or down. But every investment in gold, for the most part, is incremental. In the case of diamonds, it's very different. It's a lot like uranium last year, in that for the first time, there was a uranium fund. There were earlier ones, but the first really broadly marketed uranium funds by Sprott and Yellowcake, for example. Uranium went up 77% over 7 months last year, because that fund made it much more accessible to a much larger group of investors. And in the case of diamonds, we expect that to be similar, but much more drawn out. It's going to take 7 years, we think, for institutional investors, ETFs, sovereign wealth funds, et cetera, to build their initial positions in diamonds as a commodity. So because of that kind of one-sided demand, we expect there to be less volatility, and we expect less correlation between diamonds as a natural resource versus really almost everything else. Over time, as there's more float, as there's more liquidity, as diamond producers use the futures as a hedge, there will be volatility. There will be, like any other financial asset, there'll be supply and demand fluctuations. As we see in the Ukraine, a large supply gets shut off from Russia because of their invasion. So there will be a lot more volatility, and over time there'll be a lot more correlation too. Part of our model, though, we've created the underlying asset, right? This is the same asset, whether it's delivered by a futures contract, by an option, whether it's held by the fund or held by an ETF. So this same asset will move to wherever the demand is. And because these are all connected by the token, it's a network effect where all of these commodity demands are integrated and extremely efficient. So I think that lowers the volatility somewhat, but also creates a lot of arbitrage opportunities. I know there's a lot of traders interested in trading this asset. There's going to be a spread between the futures and the ETF and the fund and the spot and also the digital currency. Each one of those spreads we don't enforce. It's enforced by the market that knows there's an arbitrage. If it's overpriced on the futures, hit the future, take delivery and sell it to an ETF, or sell the spot commodity, or sell the digital currency. So all of those arbitrages are going to create a lot of opportunity for traders. We like that because that creates liquidity for everybody else.
Buddy Paris would like to know, can you disclose how much revenue the company has done year to date? No, he's muted. He's muted. Why is somebody telling me he's muted? I think he muted himself.
Oh, I'm sorry. I was saying Buddy is an equity investor. We're happy to tell him privately, but we're not looking to share our private company revenue on a public seminar, but it's in the tens of millions.
1 diamond bar equals 10 diamond coins, or 10x diamond coins. Will 1x diamond bar always trade at the price of 10x diamond coins, or can prices fluctuate? From Willem Berthaud.
That's a great question. So it's another one of those arbitrage opportunities. And in the case of the futures contracts can be settled by 3 different baskets. You can deliver 20 coins, you can deliver 2 bars, or you can deliver 1 bar and 10 coins. So if there were, and same with the ETF, and same with the our fund, and same with the bit carbon. So all of the financial products are pegged at that 10-to-1 ratio, but the market could trade spot at any price. The arbitrage would come if those prices diverge from that 10-to-1 ratio. You would sell the expensive one, buy the cheap one, and deliver it to the futures contract, which pays the same. So we've created this market-driven mechanism that maintains the peg itself. Now, could George Soros show up and try to break the peg? Maybe. But we've calibrated the buying of the diamonds to be proportional to the supply. So we buy basically the exact proportion, not exact, as close as we could estimate, proportion to what exists in the market over 70 years and what exists in the earth. That's the proportion that we buy in the commodity. So we expect that the demand will lift all boats, and that peg will be maintained, and all of these contracts will create an arbitrage if that peg is not maintained.
can you speak to the cost benefit of leaving the coins and bars with the custodian and paying a fee versus taking physical delivery from Stephen St. Pierre?
Great question. So diamonds are a collectible, just like gold, according to the IRS. And therefore, in most states, I think in about 47 states, if we deliver the coin to you in New Jersey, Connecticut, New York, Texas, California, etc., we have to collect sales tax. And that can be pretty painful. In New York, it's 8.75%. So our custody, we actually built a vault in partnership with Brinks in Delaware because they didn't have one there. They keep all the gold here in New York because New York has a bullion tax exemption. There's no tax exemption for diamonds. So we deliver all of the coins for custody to Delaware at Brinks. If we deliver it to you, you have to pay sales tax. Now, there is a loophole. If we deliver to Brinks and you change your mind, or if you buy a token that's already been delivered to Brinks and then you take delivery, there is no sales tax because there's no sale of the product. You're taking delivery of your own product that happens to be in Delaware, and you may owe sales tax, but it's up to you to pay it. So the sales tax is a big issue. Also, the insurance. If you add, $60,000 or $600,000 worth of diamonds to your homeowner's insurance, it's going to be expensive. Our insurance at a Brinks is tiny. It's a fraction of what it is for gold, actually, per dollar, because it's so dense. It doesn't take up so much space in the vault. So the insurance is very, very affordable. The fund takes care of all that. It takes care of the custody, the insurance, the delivery, etc. Also, if you buy the commodity, you do have to pay for the delivery, whether it's to you at home or to a Brinks in the case. But you always have the option. You can always take delivery anytime of your asset and keep it in your sock drawer.
What is the yearly cost to hold one diamond coin at Brinks? From William.
It's $36 per coin. It's $200 per bar instead of $360 per bar. So it's economically beneficial to have the bars, but they're mostly for institutions. The bars are, I think, $64,300 today or something like that. By the way, if I didn't mention it, I don't know the price because I don't set the price. Diamond Standard does not determine the price of the coin or bar. Like gold, gold mines don't set the price of gold. It's a market price. In fact, we just got it listed on Bloomberg. If you have I think it's right now in beta on Bloomberg. I don't know if it's public yet, but if you type DIAMINDX on Bloomberg, you will see the public market price of a Diamond Standard coin. That index is the standard for the ETF, for the futures, the options, etc. Can't remember if that was the entire question.
Yep. How is the recycling business proceeding? From Linda Weckler.
Hi, Linda. Another one of our equity investors. Great to, I don't see you or hear you, but great to hear your name. So we've actually are building a facility 2 doors down. We're in the final work letter process. So we have a facility. It's about 5,000 square feet. It'll be our first recycling test case, where right now we have in our office here, which I know you've visited, which is in Manhattan, we have 2 of our diamond recycling workbenches that are right now, we're testing the different types of tools and equipment. It's interesting, and I'll mention it, the way it works is anybody can send us jewelry. We qualify it on our website, and we create a ticket and a payment connection. You send us your jewelry. You can bring it to our office, or you can send it by FedEx. We open your jewelry on camera, and right on camera, we test it. We test the diamonds, we test the gold, we estimate the weight, the color, everything. We package it right back up on camera, and then we give you an instant quote. That quote is basically the liquidation value. Like based on our exchange, we know what all the diamonds are worth. So we give you an offer, you get it on your phone, and you say yes or no. If you say no, we send the box right back to you. If you say yes, we pay you immediately, and then we start to recycle those precious metals and diamonds. We break the jewelry apart. We send the diamonds to our partner, which is right up my window, GIA. They will grade the diamonds, and then they're sent to the IGI Gem Lab for assembly, and we recycle the gold. So we think that by next year, we'll be recycling $100 million a year of used jewelry. Now, it's not Cartier rings. It's jewelry that is out of fashion from the 80s, things that you don't wear, things you inherited from your great aunt. If it's, a Van Cleef and Arpels necklace, don't sell it to me because I'm going to break it up. You sell that on The Real or First Dibs or Worthy or on eBay. But everything else that needs to be recycled, we're going to be by far the best venue for anybody to recycle jewelry.
How do you expect the Bitcarbon currency to work, the necessary conditions for launch, and how investment demand will play out versus Bitcoin or other store of value coins? From Robert Rowe.
Yeah, we're actually accelerating Bitcarbon. We've really built it. We need one more. We need a regulatory approval. Everything we do, we want regulator oversight. We have a license to issue tokens, but you don't want to surprise your regulator. You want to tell them, 2 months in advance what you plan to do. We're actually in the final stages of preparing Bitcarbon for initial exchange offerings. And if you're not familiar, Bitcarbons are inside the bar. You can see it's a Bitcarbon asset. So if you own this bar and it's at Brinks, you will soon be able to convert that bar into 100,000 Bitcarbons. Those Bitcarbons you can use as a currency. You can use them on multiple blockchains. And unlike a stablecoin, stablecoins are backed by US dollars. US dollars go down in value every 5 minutes, it seems, because of inflation. This is a commodity currency, so it generally is inflation hedged, or at least better hedged against inflation. And you can always convert Bitcarbon back into a bar. Oops. I didn't break it, don't worry. But that's the benefit of a commodity currency. The chip inside proves that there's an asset behind the Bitcarbon. So the way we're going to launch it is, first we're going to get regulatory approval, but then we're doing initial exchange offerings where we have partnerships with several, kind of top tier exchanges that have regulatory oversight, et cetera. And they're going to offer Bitcarbon to consumers. We plan to do about a $100 million initial offering. And I'm not sure of the timing, but I think it'll be Q4 of this year when we actually launch Bitcarbon. And again, all of the Bitcarbon will be at Brinks. You will be able to convert from coin to Bitcarbon at diamondstandard.com and also from Bitcarbon back to coin. However, if you buy Bitcarbon on the open market and then you transfer it to diamondstandard.co's exchange and you want to take delivery, we're going to do KYC on you and make sure that you're not Vladimir Putin's daughter.
Will you be adding custodians in different jurisdictions, for example, Singapore, Switzerland? From William Berthaud.
Yes, great question. We already have approval for a custodian in Switzerland, which is Malka Amit, which is one of our partners. We already have approval in Canada for Brinks in Toronto. And we're right now working with one of the largest banks in Singapore. And that bank will actually is interested to be our distributor. So they'll be the custodian, the distributor to wealth management clients, and they'll manage the futures and funds in Singapore. So we don't have to do it. Near term, we're also looking at Hong Kong and Belgium. So we'll have two Europe options, Switzerland for a lot of people and Belgium for EU clients. A lot of EU clients can't have assets here in the United States, so they can't use Brinks. We learned that the hard way.
I think that's it for the publicly asked questions. I did want to address that Mark Trenchina, you asked a question that I replied to you privately. And if you'd like to email me directly, it's chris@diamondstandard.co. And if anybody's interested in the fund, it's fund.diamondstandard.co. But that's it.
Thank you, everybody. We've seen a great, our initial subscriptions for the fund are in the many tens of millions. We've got a couple of RIAs that have given us pretty substantial initial orders. We have a couple of wealth management firms that are offering Diamond Standard Fund to their clients. So that's what's kind of the big excitement here is this fund is really taken off, and we think it's a precursor to what will be the first ETF, and that this fund will become the ETF over time. But the timing is really important. As the demand builds for diamonds, the investment thesis has proven out over the last 18 months. This demand is driving up the market price. And so I think it's a great time to start to build a position that will benefit from all of the investors after you. And as we have more financial products, that world of investors is going to be growing very rapidly. Any other questions, please contact us at diamondstandard.co. This presentation that I gave before is available as a download somewhere on this screen. I'm not sure where, but everybody have a great day. Thank you for joining us.